Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast.
Let's try that again.
We're going to try that one more time. All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. Today, it's pretty exciting. I have not been able to sleep for like a week in preparation for this episode. So we are going to be talking one of my favorite topics.
Must be.
But it's not.
It's not really.
It's not that exciting, but it's necessary.
Yes.
We're going to talk about disability insurance. Josh, what is disability insurance? Everybody loves it, right?
Yes. So you're right. It's one of those, whenever you bring up any insurance, people's eyes just glaze over, and I want to do anything but that. And the reason is, insurance in general, you are paying money to somebody to take some risk that you have, and they're going to be financially responsible for it. So if we step back from disability, if we just look at insurance in general, car insurance. I'm taking risk when I'm driving my car that if something happens, I am in trouble. I have to fix my car and possibly other people's cars or property if I crash it, or health, anything that happens from as a result of me driving. I pay insurance, and a company says if you give me monthly or annual, however often you pay it, I will then be responsible for X amount of dollars. So you're taking the risk that I have and giving it to somebody else.
Yep. And
they're going to charge you for that.
Yeah,
so that's what insurance is from a high level.
So at the end of the day, in all insurance situations, it is less likely that you will ever get the benefit that you pay into it out of it, because that is how insurance companies make money.
Correct. So insurance use actuarial tables, which they just run probabilities and say, if we do this for enough people, and we price it correctly, we'll make money, even if we do have to pay out some of them, because more than the ones that more will not pay out, or if they do pay out, it'll be less than the full amount than what we're charging. So you're right. That's the whole goal for the insurance companies. Plus, they get to invest the money while they have it so they can earn it as well. So that's the other benefit of it. There's a float type of thing, which is a cool word. I don't know why they use that word, but the idea is you just get to take money on money you're using and grow it.
Get to earn interest on the money you're holding,
So disability insurance is the insurance, so the risk of what happens if I am disabled. So disability insurance is you're paying someone else to cover in the event that you become disabled. And so if you think about disability insurance, it's your income. So everything that you have to do, right? You have to car payments, home payments, all the stuff you need, food, groceries, utilities, all right? All those things are covered by your income while you're working, right? So while you and I have a job, we get paycheck. That paycheck goes to cover all those expenses, right? What if something happened and you were no longer able to work?
That would be very bad.
Right. And so that's what disability insurance is for, because the event that you're not able to work anymore, you have to find another way to cover those expenses. Now, if you're in a household with two people, spouses, maybe if you're both working, you may be able to survive on just one income.
Right.
Maybe not, depending on what you both are doing. But if you do, then what happens if the second person becomes, that's the whole point, is you're mitigating the risk.
It's a lot of what ifs.
Yes. And so we're going to go through some stats and stuff, talk through it all. But this is where this disability insurance comes in, because as you'll see, there's a high probability that some people listening to this may end up disabled if you look at statistics. And so this whole thing is saying, okay, the risk to me is I have to find another way of providing for all those needs. And the way of doing this, giving money to another company and saying, here, take this, and if something happens to me, you'll give me X amount of dollars a month so then I can survive.
Right. Whew.
So a way of thinking of that too, and I saw this online, let's say you're saving 10% of your income, right? So we talk about savings rates. We say 15 to 20 is the target from a high-level standpoint. Let's just say you're saving 10% of your income. It will take you 10 years to save 1 year's worth of your salary, right?
And that's
just
not
simple math.
Including any inflation.
Yeah, no inflation or changes. Just if I just do 10%, I'm making $20,000. $2,000 a year. It takes me 10 years to get $20,000.
Yep.
And then I have 1 year's covered.
And things have gotten more expensive over 10 years.
But if that's just 1 year, and let's say I start when I'm 20, so at 30, I have 1 year saved. Well, if I get injured, I have more than just 1 year I need of income coming forward, even if I have to just get till Social Security age or something like that.
And depending on what vehicle you put that in, you could have a lot of penalties and restrictions on even if you can even get it out.
So saving yourself to cover this need is very hard to do.
Yeah.
Because you're covering for multiple years.
Josh, this kind of makes me sad to think about, but I think that you have a remedy for my sadness.
I do. I always have that remedy, and it's in the form of a dad joke of the week.
Dad joke of the week, Josh. What you got?
All right. So this is kind of a two-parter, all right?
Oh, so it's a dad jokes of the week.
Well, it just involves the same animal twice. All right. So why did the cow have to keep shaving?
Because he was utterly furry.
No, I like the utterly.
Okay, see what I did there?
Yes.
Okay, yeah, that's not
no, because he kept having a moustache.
Moustache.
That was so. My kids and I were at the table. That was the joke my daughter was saying, and that was my guess.
Yeah,
which is funny because it's a dad joke, and I like it.
But that was not.
That
the
was
real
not
answer.
the answer. That was not the answer. He kept getting a milk mustache, was what my daughter said, which was very cute and funny.
Yeah.
Yes. So if you scare a cow, you'll get a milkshake. That's the other thing to think about too.
Okay. We go through the dairy products in our house substantially.
Yes.
Milk, sour cream,
Yep.
cream cheese,
it's always there.
American cheese, cheddar cheese,
yogurt,
mozzarella cheese.
Do you do yogurt?
No.
We go through so much yogurt.
Butter.
In our house. Butter.
Oh, so much
a lot
butter.
of butter.
But how many different kinds of cheese have I named?
Oh,
There's 10 more.
There's
mozzarella
a lot more.
cheese, Monterey Jack
Munster cheese.
Munster cheese. It's coming up on Halloween.
Swiss
Munster
cheese.
Yes. I don't do Swiss cheese. There's a hole. You're paying for air.
Oh man, that's to let all.
Why
the
is the
flavor
hole
out.
there?
Falls through.
Why is the hole there?
Bubbles.
I do
don't
not
know.
understand.
I have no idea.
Okay, I just named a lot of cheese. Back to our regularly scheduled program. Josh, how does disability insurance work?
Yes. All right. So here's how it works. You look at what you're making, your pre-disability income. So while I'm working, how much salary do I have? So going back to my example, I said $20,000 was what this person was earning. All right. And so I know that if I make $20,000, I don't get $20,000, right? Taxes are involved, all the other fun stuff. Maybe I'm saving for retirement and all that. So I need to look at specifically what do I need per month to cover my needs. All right. And so that's what they call the benefit amount. And that's kind of what you're targeting. So you don't necessarily need 100% of your salary covered because, and we'll get down to this on different ways they're paid out, most of the time, disability payments are tax-free. If you pay the premium, then you're not paying taxes on those payments when you get them. So I don't need full $20,000 because if
so you can look at like your net.
Yeah, so I maybe need 60, 70% depending on taxes and all that between state and federal. And then also, like I said, if I'm saving for retirement, that's not money I need, and we'll get through that in a minute. But those are the pieces that when I'm looking at, okay, what number do I need? So how does it work is first you need to say, okay, here's how much dollars I need. And then you need to say, okay, how long do I need this coverage for? So some are for a time period, some are for an age. So you can get a disability insurance that says, okay, we will pay, if you get disabled, whenever you do, we'll pay out until 62 years old when Social Security starts, or 67 when it's full retirement of Social Security. Or you can get a 5-year disability insurance or 10 years. So you can decide either by age based or the number of years. And sometimes you may have a company plan, which is a little different, where the company offers disability as part of their package, which may be more tied to like a 2, 5, or 10 year, where they'll just kind of supplement you from being disabled for a short period of time.
And those costs, they'll probably be more expensive the more higher income you're trying to replace.
Yes, so the higher income you're trying to replace and the longer you potentially have to replace it could add to make it higher. Now, if your company covers it, you may not have to pay anything.
Right.
The company may cover it. Now, if they do, you will be taxed on that since you didn't get a benefit from the premiums getting paid. Then the company gets their deduction. They pay you. It's actually a taxable event. Yeah. So just be aware of that.
Not
so when you're calculating it, not till you need it.
Right.
All right. So there's the period the amount you need, and then the period length. And then the last piece of this on how this works and kind of the pieces that you're putting together is how long do you need to be disabled before it starts paying out to you?
Right.
And so this is long-term disability. This is disability for if you're disabled for an extended period of time. So a lot of times they'll have a waiting period where it'll be maybe 60 days, so 2 months, 90 days, 3 months, a year. You can have it that long. And what happens is during that time frame, you're responsible for covering your needs. And so you may have a short-term policy. You may see, like Aflac has some things like that. You see it on TV with that duck. There's some short-term policies that pay out quicker, but in these long-term policies, they have a wait period.
Yep.
And that also enables them to get the right information because you got to prove that you're disabled.
Right.
And so you got to be able to show doctors and all the different things to say, look, I actually can't work.
Yep.
And so they got to go through that process.
And I'm sure the longer that period, the lower the cost is as well. That's another factor.
So going the other way is if I want to lower my premiums, I can say, well, if I put enough money away to cover that short term, and it goes back to your emergency fund that we talked about. If I have a 6-month emergency fund, then maybe I can do 180 days of this grace period where they don't kick in, and then I get a lower premium. So yeah, you're right. That's the other way. There's other pieces, and we'll get through those, kind of some benefits or basic policy things you need to know about. I mentioned the length of time. The elimination period, that's what they call it before they pay out. All right, so this is the important part. This is where you need to listen. There's different types of definitions for whether or not you're disabled. And this is based on your occupation. And there's a level from how wide they accept your ability to be disabled to a very narrow one. So you can have your own occupation or your occupation, depending on your company. They name it funny. But anything related to what you do currently, that's the best policy to have. Because if you're still able to work but just not in the field you were doing, they'll pay out your disability, regardless of if you can actually go to work somewhere else. That's key because let's say you're a doctor, all right? And you have this own occupation and you're a surgeon, so you need your hands, and then you're Doctor Strange in the movies and you have your hands crushed in. Well, if you
haven't got that far yet.
Well, it's not a spoiler, all right? He hurts his hands. That's whole character.
I'm working through the Marvel series and I'm only through Ant-Man.
Okay, so Doctor Strange is a doctor. He hurts his hands.
Okay.
End of story. Didn't spoil anything. Anyways, if he had own occupation, being unable to perform surgeries anymore, he would qualify for disability insurance, even if he could go out and do something else.
Right.
And that's what you want because you want a very narrow translation on what's disability. If you have any occupation, they will not pay out your disability claim until you prove you cannot work anywhere. So, that, again, going back, let's say I'm a doctor and I'm earning $500,000 a year because I'm a highly sought-after surgeon. If I get in an accident or something happens where I'm unable to perform that level, but yet I can teach at a local university and now I'm earning $60,000 a year, my disability will not kick in if I have any occupation because I'm able to work. And so, again, that's a change of lifestyle. That changes everything on my planning. Whereas if it was own occupation, I could go get a job at the university. Depending on your plan, they may offset, but more often than not, they'll pay your full amount out, and then you can earn extra money on the side.
Wow.
Because again, going back to it, I'm probably only getting maybe 60-70% of what I was making before because it's after tax. So then I could maybe offset a little more with a job somewhere else. But that's the benefit. You want own occupation or your occupation, something that's tied to what you're currently doing, especially if you're in a high risk of an injury, limiting that. So if it's a physical job or something that requires a skill, especially, or, if I can't do it while I'm blind, those, there's certain things that, okay, if this type of disability affects me, how will I be able to perform it? Especially, lifting, those type of things that require physical exertion. If I'm unable to do that, I'm out of that job.
So, Josh, moving to the next point, I think that we should talk about, now this brings me back to my background in actually plant accounting, we talked about,
so
this was pension accounting.
Is this like leaves, like plant accounting? Like
plant accounting, yeah.
All right, count the leaves, count the flowers.
So pension accounting, so much fun. But, you get thirsty when you're on the job.
Yep.
And sometimes you need to have a drink of some cola.
Yes.
Or cost of living adjustment.
You need some cola.
This is what we're talking about. So things get expensive over time. inflation occurs over time. The historical average for inflation is 2.5 or 3% over a long period of time of the increase of the basket of goods, quote unquote. I'm doing air quotes on a podcast.
There you go.
Basket of goods increase over time, year over year. So, cost of living adjustment. Explain how that relates to disability insurance and how that can be a factor too.
Yeah. So let's say I am a 30-year-old person and I get disabled and I have a policy that pays me out $2,000 a month and that covers what I need. So I'm happy. Everything's working out. But when I'm 40, if I don't have a cost of living adjustment, a COLA, I'm still getting $2,000 a month on my disability, but I'm not as happy because everything went up is more expensive. So my $2,000 is not buying what it did when I first got disabled.
Or over that period of time, not nearly what it was.
No. So that's why I'm not happy. So what you need is some sort of increase in your benefits if there's an increase in inflation. So a cost of living adjustment. They'll a lot of times tie it to a percentage. They may say like a 2% cost of living adjustment or inflation plus, or, depending on the company, they'll adjust it some way or another. But you want some sort of cost of living adjustment. Now you're going to pay for that because they need to be able to recoup that in order to decrease it over time. Now on the other end, there's also what's called future increases of my benefit. So what this is saying, okay, let's say I am a 30-year-old and I'm making that $20,000 I used in my initial example. Well, most people get raises periodically throughout their career. So let's say at 40, I moved up and I'm in a different position, and now instead of earning $20,000, I'm earning $40,000 a year, okay? And so now if I had a disability insurance that I got way back when I first started based off of $20,000, that's not going to cover my new lifestyle and my new income. So what they allow is for future increases without really needing to requalify through medical exams and stuff, is just saying, okay, we understand you're going to earn more money over time. We'll give you this kind of range where we'll increase them as your salary goes up, and you have to prove that you're not just saying, well, actually now I'm making $80,000. Well, no, they want to know what your actual salary is, but they'll allow you to increase that starting benefit amount over time based on what your salary is doing. And then if you reach a cap, you then have to probably go through a new medical exam or something. But they'll give you a pretty good cap to get through that. So most working careers, you can keep the same policy but increase it over time.
So both of those components go to making the benefit, should something happen, A, move up if you don't need it so that your starting point would be close to where you're at on a salary basis, but B, also then extend to increase as cost of living increases over time. So you've got two components of increases over time.
And those would be two separate ones, and you can pick and choose how much.
And the more you lever those up or down, that can definitely change your cost. Wow.
Yep. So that looks at salary, okay? And that's what's covering the disability. Basic part of disability is covering your income needs.
Yeah.
Along with that, there's a lot of things you can add into that. So disability insurance is a broad insurance that an insurance agent can really help you understand additional riders or add-ons. A rider's what they call insurance world, an add-on or an addition to your policy. And so you could say, hey, me, Josh Robb, I have 4 kids. What if part of my plan was to be saving for college for my kids, but then I become disabled, so I'm no longer able to earn the money to put aside for college? If I added a addition to my disability insurance that said, hey, I want this additional benefit for this thing, there's certain things that you're able to do. Now, there's student loan protection. Now, that's usually for you personally, where if I have student loans, my disability will also help cover those. But they do have retirement protection, which is I'm saving in a 401k while I'm working. But what if I become disabled? Well, great, my disability insurance is coming during my working years, but come 62, 65, 67, whenever it stops, I'm now just relying on Social Security.
Right, because when you were putting in money to your retirement as you're working, that's great. But as soon as you start claiming the benefit, you become disabled.
I'm not working
you claim
anymore.
the benefit. You're no longer getting paid for your job, so you're no longer contributing. So you may still have your money in your retirement account, but it's not getting added to all the time. So that's what you need to include that provision.
So you get a provision. They'll actually, during your claiming of disability, be adding to which in a sense kind of an annuity type of thing, as a retirement piece. So once 67 hits or whatever that stop point is, they no longer give you disability, but that bucket then becomes your payout for retirement. So they're in a sense, they're adding to your retirement like you were. And so then those other goals are able to be met by your other assets, like the college saving that I mentioned. I no longer have to worry because my retirement's taken care of from the rider. Now any assets I had saved can go towards college. What about, let's say I do get disabled, but I can work somewhere else, but just not in my field. They can have riders that help you get education or get you back into the workforce. Because again, if you have any occupation and I'm temporarily disabled, but I know I can't go back to my field, I may take advantage of something like that to get a skill that I can get back into a workforce, because if I know disability is going to kick out anyways, I'd like to at least have some new skills.
Yeah.
Then you can add on some ones that if you own your own business, there could be some sort of policy that, okay, what if I'm one of the owners or one of the key people and I can no longer work there? Some sort of thing to help the company, there's a buyout or some sort of thing to get me out of the kind of equity I built in there. So there's some add-ons, and it really just depends on your situation, what makes sense. But I would encourage you to check into at least the retirement piece because, again, we're encouraging you to save while you're working. And if that's not happening, there will be a shortfall at some point, or at least a very tighter budget once you're just relying on Social Security at that point.
And don't forget, there are definitely some specialized solutions out there for those hard to replace, earners.
Yes.
So for that specialized surgeon example you used, that is something that there can be you can write special policies. Now, obviously, the more specialized and the higher the income these policies are, the higher the premium is going to be. But there are provisions and options out there for very, very specialized situations where it's hard to replace. So, Josh, this is now we kind of understand what the topic is. We understand disability insurance and kind of how it works. Let's talk about bringing it home. Who needs disability insurance?
Yes. So you and I, we got some stats. We like statistics.
I like stats.
We like numbers. We like to talk about that. I'm going to start by saying there's a higher probability that you, and I say you as people listening,
or me,
you in general, you will be disabled instead of dying early. So if you're working, you have a higher probability of being disabled than dying early. So we talk a lot about life insurance. We'll have a whole topic on life insurance in a future episode. But people spend more time worrying about life insurance than they do disability, even though statistically, more people are disabled than die early during their working career. So what are some of those stats?
Well, according to statistics, we know that 3,000 Americans become disabled every hour. Hour.
That's crazy.
There's 24 hours in a day. Mm-hmm. That adds up quick.
It adds up.
So a 30-year-old is 4 times as likely to become disabled than to die before the age of 65, kind of like what Josh had just talked about there. And most disabilities, so around 90%, are actually due to illness, not injury. And about 95% of disabilities are not even work-related.
Yeah, so when we talk about that would be heart problems, heart issues, cancer, those type of things.
They're not from your job.
No, but they can totally disrupt your life.
Absolutely.
And so, that's what we're talking about. When it talks about illness, the primary two are heart diseases and cancer are the primary two causes, but there's other ones out there. But it's not just, I fell at work and hurt my back and now I can't do it anymore.
That would be a whole other type of claim anyway.
Right, but those are what people think of a lot of times, is the injury side of things. But usually it's not an injury that slows people up.
And think about your mortgage. Think about your house. So most Americans, have a mortgage for the house that they own, their primary home. Over 50% of all foreclosures are actually caused by medical problems, not by maybe a loss of a job or something like that. So, I'm sure that is, that's a huge portion of people's income requirements that they're using.
Yeah, the mortgage,
is their mortgage. So that is a huge portion of those foreclosures that we see.
Yep. So Social Security Administration has their stat. They say 1 in 4 20-year-olds will be disabled before they reach retirement age. So
where's that leave us? Are we like in the middle?
I'm older than that, so I'm on my way. I'm trying to get through there. And then about 70% of Americans would find it difficult to meet expenses if their paychecks were delayed even 1 week. So we talk about living paycheck to paycheck. That's what that is. Right. Is that there is no cushion. There is no emergency fund there that if there was a disruption, I would struggle to be able to fill all my needs, and which goes back to that foreclosure issues, is if there's a disruption in my ability to make money, which we saw earlier this year with COVID-19, that causes a lot of problems, even if it's not your fault. And so that's kind of where we're at, is in this disability insurance, is we need to make sure that since there's a way to mitigate that risk, push it off to someone else. And honestly, we haven't talked about the cost yet, but it's not super expensive for disability insurance. When you look at the big scheme of things, it probably costs less than your car insurance in most cases. It's not really like it's hard to get or hard to pay for. It just, you need a plan for it, you need a budget for it.
And so there's two routes to even go about that. Obviously, there's the go out and get your own policy just like you do life insurance, just like you do car insurance, whatever, private. But there's also a public option, right? So Social Security disability insurance.
Yes.
Talk about that a little bit.
So SSDI, if you ever see that, it's Social Security Disability Insurance.
We love our acronyms in finance.
And so it is, so if you think about every paycheck you pay into Social Security, you pay into this program, part of what you're paying into is this disability insurance. That if I become disabled, Social Security will provide me with some income. All right. Now you have to work a certain amount of credits to get this, but once you have it, it's always there for you, and then it'll be available from whenever you're disabled. And they have their own criteria. You have to not be able to do certain functions. They have this list of things to qualify, and it's to prevent fraud and all that stuff. But if you do qualify for Social Security disability insurance, they'll pay you their insurance all the way up until you qualify for Social Security. Then you just switch to Social Security. It's all in the same bucket, just name two different things.
Exactly.
So they'll pay you then for the rest of your life. So pretty much if you're disabled, Social Security, and qualify for it, Social Security will cover. The problem is, on average, in 2019, Social Security disability insurance paid on average $1,234 a month.
When I saw that number in the note, that
1234,
it went
You
1,
thought it
2,
was
3, 4,
typo.
and I was like, Josh just put a placeholder in there.
Type.
Nope, that's real.
That is it.
$1,234 per month.
So $1,200 a month.
Yeah.
Think about all your needs: your food, your
That
utilities, mortgage.
Right.
It's not a lot, which is why, again, we come back to, it's there.
Yeah.
Like Social Security, it's a safety net to keep you from being in total devastation, but it's also not there to provide much more than that safety net. And so, as a result, that's why outside of the public sector, Social Security, disability insurance, private insurance companies are selling these policies.
Yeah.
So the biggest issue is, where do you get this? All right. So we talked through what is Social Security, or what is disability insurance, who needs it, which is everybody that's working. Finally is, where do you get it?
Yeah.
So I would say first and foremost, especially if you work for a large company, ask your human resource department. Say, do I have any form of disability insurance with my employment?
Yep.
Do you guys offer something? And so if they do, find out what that is. So what does it cover?
Yep.
How long does it cover? How long do I have to wait to get that?
And it might be covered. There might be a great policy, which is wonderful.
Might be perfect.
But even if it's not, it might be extremely affordable because larger companies can often have a lot of leverage with these insurance companies to get great deals for their employees.
Yep. So if your company doesn't, don't panic. Anybody can buy disability insurance. You can be self-employed. It doesn't matter how you're getting income. You can apply. So shop around, go out, find an insurance agent you trust, have them look for quotes. I will say too, if you're part of some sort of group or network or affiliation, check with them. They may have also negotiated a group rate for anybody a part of that.
Yep.
So, for instance, at my office, a group of us are part of an association for financial planners. They have a group disability policy that if you wanted to, you could join into them with that group. Don't have to, but it's there. They offer a certain discount, and they kind of give you the rules and stuff. I know that's available for dentists and all different industries. They offer some of those things. And the same is true with like life insurance stuff. They just group stuff together, which is great. Teachers, they have some opportunities like that through their teachers' retirement plans. So just check around, see if you're affiliated with something that may give you a discount or ability to get in. Some may even waive the medical requirements. So the blood work and all that crazy stuff they do just to check to make sure that there's nothing right now that's going to impact like an immediate claim. And so some of those groups even waive those.
Yep. So one thing to keep in mind, as you mentioned earlier in the episode, is that if your company pays the premium, when you start claiming that, it will be taxable, where if you're paying the premium, that will not be.
Correct.
So keep that in mind. It's very different.
Yes. And so who pays premiums on insurance matters to the IRS. And so that's a big deal. To clarify, Austin, it is tax-free when you're paying the premiums of after-tax dollars, which would be, if I get my money, if after taxes is my take-home pay, and then I pay my own premiums. But either if my company pays the premiums or I'm paying pre-tax kind of like we do with my 401k, before it's taxed, it doesn't count as my salary, then I'll have to pay taxes on my benefits. So just want to clarify.
Yeah, which end of taxes this occurs on.
The IRS cares, is it pre or post-tax that pay the premiums?
Also, just don't think that you have to go with the first thing you see.
Yep.
It does pay to shop around, and there are a lot of companies with a lot of different options, and you can slice and dice and do what you need to do. But shopping around, this is an area where it can definitely pay off.
Yep. And work through, talk with, if you're a family unit at home, talk together, like what makes the most sense? What are the goals as our family? What makes the most sense that we need? Because if something would happen to me and I was then forced to not be able to work anymore, how would that change the dynamics? What would we need to in order to go forward? So talk through that, make sure you have a good plan, and then shop around to see what best matches that, what your ideal situation would be. All right. So we have, talk through disability insurance, why it matters. And I mentioned it maybe once or twice, but in general, if you have a financial advisor who you trust, have them help you with this, because part of what a good financial planner is doing is not only looking at your investments and talking through those pieces, but they're looking at the other parts of your full financial plan. And one of those is insurance and risk management. And so they should be talking with you about that. And if they haven't, just bring it up and see, what are your thoughts? Do you know of anything that I'm missing on this disability? If you get some quotes and you're not sure, show it to them. Say, what are your thoughts on these? Which one makes the most sense to me?
Yeah, just like life insurance, this is a piece of that grand picture.
Yes. So, and if you don't, and you'd like to find out some financial advisors, feel free to reach out to us. On our website, we have a link. You can email us at hello@theinvesteddads. It says, I think, invest with us.
Yep.
And so we can love to talk with you. And if we're not a good fit, we can try to help you get connected with somebody that is. So, Austin, what else can they do?
Yeah, and don't forget, we have a free gift on our website. It's a brief list of 8 principles of timeless investing. These are overarching investment themes to keep you on track to meet your long-term goals. These are just kind of high-level things that it's good to take your mind off of the choppiness we see in the markets, whether that's due to a pandemic or an election or whatever else may be going on. 2020 is throwing a lot of curveballs, but this is just good long-term things to keep in mind. Josh, how can people help us continue to grow this podcast?
Yeah. First of all, subscribe. That allows you to get alerts to say when we drop a new episode every Thursday. Also, leave us a review, especially on Apple Podcasts. That's great to help us rank so that more people can find our podcast. And if you have any ideas, which is our favorite way of choosing topics, is hearing from a listener.
Absolutely.
Email us at hello@theinvesteddads.com. There's a link again on our website, theinvesteddads.com, where you can send us any thoughts or questions or topics.
Yeah, and don't forget, if you know someone, maybe someone was asking about this topic, or your friend was like, hey, what is disability insurance? Don't feel like you can't send this episode, because you can hit that little share button, send it to your friend, and hopefully that'll answer some of their questions. We'd really appreciate if you did, and it would help us grow. Thank you for being here this week. Until next Thursday.
We'll talk to you later.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.